Welcome. We're doing a deep dive today into Dixon Technologies' financial performance for fiscal year 2025 and comparing it with last year, FY24. You've got their earnings release right here.
That's right. And our job is to pull out the key insights for you, the investor. We'll start high level, then, compare year over year, focusing on revenue and profit trends.
And then touch on some other important bits from the report, too.
Exactly. Other crucial aspects that matter for understanding where they stand now and, well, their future potential.
Okay, let's kick things off. The consolidated results for FY25. They look pretty strong at first glance. Revenue from operations hit 38,880 crores.
Yeah, a massive jump. That's up 119% compared to the 17,691 crores in FY24.
Wow, 119%. What's driving that kind of surge?
It really highlights their strength in the EMS sector, electronics manufacturing services, especially, it seems, in mobile manufacturing. They're capturing market share.
Right, makes sense. And this growth carried through to earnings.
It did. EBITDA, that's earnings before interest, taxes, depreciation, and amortization, was up 112%. Came in at 1,528 crores.
Okay, 112%. And profit before tax, PBT.
PBT saw an even bigger rise, 218%, reaching 1,570 crores. But there's a key point here. This includes a significant exceptional item.
An exceptional item. Okay, we'll need to unpack that. And the bottom line, net profit after tax before non-controlling interests.
That also surged, up 229% to double 233 crores from 375 crores last year. So yeah, very strong upward trends overall.
Let's zero in on the comparison then. FY25 versus FY24. These trends held up through the year.
They did, both through the full year and also just looking at the last quarter, Q4 FY25. Revenue in Q4 alone was 10,304 crores.
Which is a 120% increase year over year for the quarter. Pretty consistent with the full year.
Exactly. And EBITDA growth in Q4 was similar, up 128% to 454 crores.
And the PBT, you mentioned that exceptional item affecting the full year figure. Was that in Q4 too?
Yes. It significantly impacted the Q4 reported PBT as well. The reported PBT for Q4 FY25 was 576 crores, which is a 343% jump from Q4 FY24. Massive.
But not all operational.
Correct. If you strip out that exceptional item, it's a fair value gain on an investment, specifically their stake in Aditya Infotech, due to a share exchange.
So like a paper gain, not cash from selling phones or TVs?
Precisely. If you adjust for that, the Q4 PBT growth was still very healthy, 151%. Came in at 326 crores adjusted.
Okay, 151% adjusted. That's still really strong growth. And adjusted PATE?
Same story. Adjusted PATE before non-controlling interest for Q4 was 249 crores, up 157% year over year. So the underlying business is performing well, even without that one-off gain.
Got it. Okay, let's shift gears a bit. Beyond the core profit and loss numbers, what else should investors be paying attention to from this report?
Well, first thing, the board's recommended a final dividend. It's 8.4 equity share for FY25.
Subject to shareholder approval, of course.
Always. But it's a positive signal, a direct return to shareholders.
Definitely. And I saw something about auditors.
Yes, they've appointed a new secretarial auditor, Ms. SBYN and Associates LLP, for a 5-year term starting FY26. Again, pending shareholder approval, standard governance procedure.
Okay. And it looks like they're expanding too. New subsidiaries and acquisition.
Right. They've set up several new wholly owned subsidiaries, Dixon Electroconnect, Dixon IT Devices, Dixon Teletech.
Suggests they're pushing into related areas or maybe deepening their focus.
Seems like it. Diversifying, potentially strengthening their supply chain or market reach. Plus, they completed the acquisition of a 50.0% stake in Ismartu India Private Limited.
Expanding their portfolio that way too. Now, back to that exceptional item for a moment, the Aditya Infotech gain. Just to be clear for investors.
It's really crucial to understand this was a one-time accounting gain, a revaluation. 250 crores in Q4, over 160 crores for the full year. It boosts reported profits significantly, but it doesn't reflect the core operational earning power.
So focus on the adjusted numbers for the real trend.
Absolutely. That gives you a much clearer picture of the underlying business performance.
Okay. We should also touch on the different business segments. Was the growth even across the board?
Not exactly. It's a bit of a mixed picture. The mobile and other EMS division was the real star performer. Revenue there grew by a massive 225% year over year for FY25.
225%. So that's where a huge chunk of the overall growth came from.
Definitely seems that way. Reflects strong demand in that space. But on the other hand, consumer electronics and appliances actually saw a decline, down 13% year over year.
Interesting. Any idea why? Market saturation, competition?
The report doesn't specify, but yeah, Could be various market factors affecting that segment. Home appliances and lighting products showed positive growth, but more moderate, up 13% and 9% respectively.
So it's important to look under the hood at the segment performance, not just the consolidated number.
Exactly. And just rounding off the financials, some key ratios look better. Return on equity, ROE, and return on capital employed, ROCE, both improved significantly in FY25.
Showing better efficiency, using capital well.
That's the idea. And their debt-to-equity ratio remains low, which is healthy. They aren't over-leveraged. Plus, operating cash flow remains strong.
Okay, so pulling it all together, what's the main takeaway for you, the listener? Dixon showed, well, really significant growth in revenue and profit in FY25.
Driven largely by that booming mobile and EMS segment. Strategic moves like the dividend, the new subsidiaries, the Smart2 acquisition, they all signal continued development and ambition.
But, and it's an important but, you need to understand the impact of that one-off exceptional gain. Look at the adjusted figures.
And be aware of the different performance levels across their various segments. Consumer electronics down, EMS way up. It's not uniform.
Right. So this deep dive gives you a snapshot. But digging deeper into what's driving each segment and whether this explosive EMS growth is sustainable, that's probably the next step.
Definitely worth further investigation for a full investment perspective.
Don't forget to subscribe and tap the bell icon to stay updated on the Indian stock market.